Welcome to the call. Happy St. Patrick's Day, my friends. I hope everybody's wearing green. I'm going to actually put the camera on you. In fact, I see a couple people right now that are not wearing green, and I'm a little disappointed. So I'm going to point you out here in just a minute. And I'm just kidding. I don't actually have cameras. People are probably freaking out right now going, holy crap, they can see me. You know who you are, though. You do know who you are that aren't wearing green today. So appreciate you being here, everybody, and have an awesome class for you guys. Like I said from the beginning before the intro, Vern Motter, great friend of mine and partner, actually, we're working together to keep more of my money. And I thought, you know what, Vern, we got to help our agents do the same because we only get we only get one chance in life to make money and keep money and save money and all that fun stuff. So, dude, I appreciate you being here. I appreciate you. It's early over there in the California area. I appreciate you getting up for us, and you're probably up earlier than this anyway. But how you doing today, man?
I'm fantastic. Thank you so much. It's so great to be with you again.
Absolutely, man. I appreciate you coming back, and I know you've helped a couple of our members, and I appreciate you doing that. And dude, I appreciate what you've been, what you and I have been working on personally, and I think it's great that you have some very creative vehicles that will help agents or anybody for that matter that's paid in this manner as you are a real estate agent to benefit and keep more of your money in the bank or in an investment type vehicle. Hope I said that right, politically correct.
Yeah, absolutely. Yeah, so this is cool. So, I always start with how I can save you up to $50,000 on your income taxes every single year, and everybody goes, oh, really? This is the same presentation. Well, I changed it up a bit. There's a few things I wanted to add and a few things I wanted to talk about, but I have to tell you, I just had to leave that hook in there because that's really the goal, right? If I can do that, if I only save you 25, great. If I can save you 50, if I can save you 100, awesome. But that's really what I like to do. That's always my goal with a client, especially at higher income levels is, hey, how can we save $50,000 every single year? And there's a lot of cool ways.
Shoot, Vern, if you can save me $500 a month, I'll sign up for that.
It's cool, right? I'll talk about it.
Right.
Wealth is created in the margins, so it's not just this big deal that makes you wealthy. It's a lot of those little savings that you get. But let me tell you a little bit about who I am, okay? So I've been a tax strategist and CPA with small businesses for over 20 years. I used to have a nationally syndicated radio talk show, and I wrote a book called Keep Your Money, How to Save $5,000 to $50,000 in Income Taxes Every Year. So this isn't about me, but I wanted you to at least know who I am. There's my book, and I tell you what, I'll give you a moment. You can write that email address down. If you email that, what I'll do just for you all being on here is I'll send you a link to a free download of the book, so you can use it as a reference.
No kidding. Thanks, brother. Thank you.
Stuff in there. So it's kind of cool. I want to give that to you guys today just for taking your time to actually listen to some ways to save money. So let's dive in. I'm going to talk about kind of two core strategies, and those two core strategies are this. Future tax savings. So many people, and some CPAs don't even work on planning for your current year. They just fill in your tax forms. Very, very few ever talk about future tax savings, and I'm really excited about a lot of tools that there are out there for future tax savings as well as current tax savings. So we're going to talk about both of those today. So let me ask you a question. Who's a better steward of your money, you or Uncle Sam? I think you all said, hey, I think I can do a better job than Uncle Sam, right? They're 20 trillion in debt or whatever.
Oh, boy. Worst business in the world, right?
Is it better to pay taxes now or later? What do you think?
Yes. Now. Neither. Okay,
right?
great. I like that.
Wouldn't it be cool if you can save some money now as you're going and save money later? So that's kind of where we're going. But when you break it down and we talk about tax savings and making more money and all of that, it comes down to something very simple, and it's like, what do you really want? And I ask that question so often to people, and you get the standard, oh, I just want to be comfortable, or I want happiness, or I want this, or I want that. And I think the real answer is we just want freedom, right? We want freedom of choice. You want to be able to send your kids to whatever school they want to go to. You want to be able to take time to go to the ball game. You want to be able to do what you want to do when you want to do it. And that's really what all this comes down to. You can take away taxes and money and everything. If you just had that freedom, no matter what, at no cost, I think everybody would have happiness and you'd have that sense of fulfillment. The challenge is that wealth equals that freedom. I used to always say, look, you can either be really, really poor and have that freedom, right? Do what you want when you want to do it, or you can be really, really wealthy, and wealthy is probably the more fun road. And so we talked about this just a moment ago, but wealth is created in the margins. So when you can save that $1,000 in taxes, or you can make that extra deal for another $3,000 or $4,000, those are the margins. You're going to hit those home runs now and then, but those small little base hits that win baseball games, right? That's where it's really exciting. So let's talk about future tax savings. There's really 3 ways to invest your money. Call it tax today, tax tomorrow, and tax never. I like to say tax always, tax later, or tax never. And what does that mean? I mean, taxes have been with us for a long, long time. We all have to pay them, even though we don't really want to. It's a necessary evil, if you will. But the way you structure your affairs makes a huge difference. And so when we talk about this, I'm going to switch over and kind of draw some of this stuff out for you, so bear with me here.
No worries.
There we go. So let's talk about some, I love to draw buckets. This is always. This bucket we'll call later. Okay, so now you can all laugh because I am no artist. That's why I'm a CPA. But I like this one. That's never.
I like that one
Okay,
best
so what's
too.
this tax always bucket? This is like your brokerage account, your bank account, just normal savings, right? We put after-tax dollars in there, and then Uncle Sam takes a haircut every time. And I know we have some Canadian guests on as well. I'd like to welcome you all. I got a phone call yesterday after you sent your invite out, Scott, from Myron up in Canada, and he said, hey, is there going to be anything that can help my Canadian agents? Can I invite them? And so we talked about the presentation a little bit. And so if I make some references to Canada, I want you to know, all the Canadians, that I went out and did a little research on some of these strategies, and hopefully I'll be able to apply some of those to you. So let's talk about tax always for a second. Well, actually, let's go over here. Tax later. This is like your 401k. That's what a lot of people talk about, right? It's your traditional IRA. It's annuities. And I'd also, quite frankly, this might surprise you, but I'm going to put real estate in here as well. A lot of our real estate clients who are super successful, they buy a lot of property and then they depreciate those out, which is great because, right, you have cash income now and you don't pay tax on that income because of the depreciation. Our challenge has been with several of our clients now is that they're in a position where the depreciations run out and they're trying to work out strategies to save taxes without that depreciation. So it's kind of a tax later. And then we go over here to tax never, and there's really a couple of ways to do it. There's a Roth IRA, and then there's what we call a 7702 plan. The Roth IRA, a lot of you might say, well, I make too much money to contribute to a Roth. And that may be true, but there's a loophole I'm going to tell you about where you can make a Roth contribution. And for real estate investors, anybody of your clients maybe, if it's not you, that flip houses, there's a really cool way to do that inside of a Roth IRA using options, where you can take the $5,000, which doesn't mean a lot to a lot of people because it's not going to grow to very much, but you can literally create hundreds of thousands of dollars worth of wealth inside of a Roth IRA each and every year if you're actively turning houses. So it's pretty cool. And you might say, what's a 7702 plan? Well, all that is, I'll tell you, is it's a cash value life insurance. Now, it's a little different than what most people think of as life insurance, but it's just kind of a different wrapper. So each of these are just a vehicle. And I'd say the tax always is kind of like the Ford Focus, right? And the tax later might step up to the BMW Mercedes level, and then the tax never is your Ferrari or your Lamborghini or whatever you want to do at 220 miles an hour. So every vehicle is different, and each vehicle for you is different. What a lot of people do is they listen to, and this is kind of a fallacy, they listen to this talk on the street or what they see on the internet or something like that, and they say, oh, this doesn't work because of this. Well, you don't know that person's personal goals and objectives, and that's so important when you're talking to anybody, whether it's a tax strategy, an investment strategy, a marketing strategy. We all know that has to work for you. You have to be able to do that. So you have two people standing side by side, and their plans may be very, very different. I have a client who's an auto dealer, does really, really well. He grosses about $5 million a year, and I've created several strategies for him, and he said, Vern, that doesn't work for me. And the reason is his personal goals and his personal aspirations and what he wants to accomplish. So everybody's different. We finally found one that we landed on that's going to save him close to $100,000 a year in tax. So you just have to keep tweaking until you figure out what's right for you. Let's put some numbers to this. So we come over here to tax always. And I'm just going to say for all of these that we're going to put in $50,000 a year for 20 years. And I do that just to keep the math easy. If you put $5,000 a year away or you put $100,000 a year away, there's ways to do it. So $50,000, and we're going to say that we're going to make 7.5% on all of them, okay? Fairly easy return. The tax always challenge is to get that $50,000 in that bucket, you have to make about $71,000 and pay tax on it. And I'm assuming a 25% tax rate and 5% state, okay? Pretty normal probably for all y'all's income level. So what's that look like in 20 years? Well, that grows to $1.8 million, okay? Hey, that's not bad, right?
Not bad.
I think we can like that. So now let's say we wanted to take $150,000 a year out of there. Well, we paid tax on this all the way up, and now when we sell it, a portion of that's still going to be taxed at capital gains rates. So we have to take out $165,000, and by the way, I use a capital M because it's Roman numerals. It's kind of a geeky accounting thing, so if you don't see me use K, which you all are probably used to, that's why. So if we're going to net $150,000, we have to take out $165,000. Okay? How long do you think your money is going to last, right? Not as long as you thought it was when you're just looking at the $1.8 million. So now let's move to our tax later bucket. And there's also a really cool plan called a defined benefit plan I'm going to touch on later. We're going to go through it really, really fast, but it's like a 401k. You know, you can put away about $52,000 a year. Your IRA's, you know, $6,000 or $5,500 and $6,500 a year. A defined benefit plan is like one of these 401ks or IRAs on steroids. I mean, we've created plans where certain individuals could put away up to $600,000 a year. I have a client who regularly puts $150,000 a year away because that works for him. The tax later bucket, he likes that, okay? So if we do the same thing, we put $50,000 in every year for 20 years, 7.5%, that grows because of the tax deferral to $2.4 million. Now, who wants $2.4 million versus $1.8 million? Anyone? Everyone? That's pretty good, right? That's just the power of not paying tax every year on your earnings. That's pretty powerful. That's a big difference. Now, here comes the question. What do we have to take out of there? Let me give you an analogy. The tax later bucket. Think about a farmer, and he takes his seed and he puts it in the ground, and it grows into a big harvest. And I think we all know, whether you farm or not, that you put a few seeds in the ground and you get a lot more volume out of that, right? It grows into this bountiful harvest. The tax later bucket is like Uncle Sam saying, hey, I'm going to let you have your seeds for free. Okay? You just take those seeds and you go make them grow. All I want to do is tax your harvest. And then the tax never bucket is Uncle Sam saying, okay, look, I'm going to tax your seeds, but you get to enjoy your bountiful harvest all on your own, free of taxes. Okay? So using that analogy, we've saved money in the tax later bucket of our seed, so to speak. So it grows to $2.4 million. He's going to tax all of that when we take it out. So we actually have to take out $214,000 in order to get down to our 150. Woo! Can y'all read that? What's that difference? That's $70,000 of tax just to get that out, right? Not quite. It's insane. So now let's go over here. This
It's insane, man. Yeah.
Insane, $2.4 million, okay, because it grows tax-free. Here's the nice part, though. When we want to take out $150,000, we take out $150,000. So if you just looked at the numbers, the $2.4 million at 7.5% is going to generate about $180,000 a year. Well, you can see if you're taking out 214 and it's only generate 180, and that's in year one if you're not drawing down the principal, you're going to slowly erode your principal in the tax later bucket. The tax later bucket is going to pull out 150, but it's to grow by that difference. That's the power of compounding. That's how wealth is created in the margins. So what bucket is better for you? I don't know. Where should I put my money? It depends. Should you have some money here? Absolutely, because that's easily accessible, right? We all know that IRAs and stuff, they tie up your money for a while.
Yeah.
So you need to have some in the tax always. Should I have some in the tax later? Yeah, maybe so, right? You should probably put some money here. And should you have some here? I think you'd all say definitely. So it really doesn't come down to an either-or situation. It comes down to an and situation. A combination of these two in your retirement allows you to control this income that you have to take out and what you have to pay tax on. So if you had a combination of those two, you could say, well, I can take this much out tax-free, and I only have to take, say, $50,000 out of here, and I don't have to pay that much tax on that to get there. Are you with me?
Yep, absolutely.
Perfect. So if you think about this in this respect,
here's a question for you, Vern. Is there a now there's going to be a max for the never bucket. There's probably a max for the later bucket too, as well, right? Per year.
Yes. So
the always bucket, like in a bank, you can have as much as you want, but
yeah. So it depends on the vehicle you use inside each bucket. If all you wanted to do was the traditional IRA, right here, you know, you're going to be limited to, depending on your age, $5,500 or $6,500. A 401k, if you set it up properly, you can put away about $52,000 a year. A DB plan is structured differently, which we'll talk about a little later, but you can put, you know, as little as 50 to as much as, well, the one plan we created was $600,000, and that's what worked for that guy. So there's a lot of different mechanics to that, but you pick your vehicle that works for you, and then we work into that. Then the tax never bucket, a Roth IRA. The reason most people don't get too excited about it is you can only put away $5,500 or $6,500, right? And if you make over $160,000, they're not available to you. So they're not that exciting for high income earners. But let me tell you the loophole that has been created. You can always make an IRA contribution even if it's not deductible. So you can make a regular IRA contribution in that tax later bucket of, let's just call it $5,500. And you might make too much money or might have a different plan, and so that's not deductible. So that's after-tax dollars. The loophole is this. You can now roll that almost immediately into a Roth IRA because they remove the income levels for rollovers to Roth, and you're still not going to pay tax, and now it grows tax-free and you pull it out tax-free. So that's really pretty cool. So you take that tax later bucket, that IRA, and you roll it over into a Roth, and if you didn't get any tax benefit for that when you put it into the tax later bucket, now it's going to grow tax-free and you've moved it over to the tax never bucket. So really what you've done is you've taken a one-step process and turned it into a two-step process because our government always loves to make things simple for us. So anyway, the 7702, the way that works, and you know, I've seen some stuff, there's all kinds of stuff on the internet, and again, that's why I say you have to really be careful and make sure something's tailored for you. But I saw something that said, you know what, there's really no such thing as a 7702 plan. It's just a label for insurance. And, you know, that's true. Insurance is the vehicle. But what they failed to say was there's really no such thing as a 401k plan either. Or a 401k plan is just a retirement plan under Code Section 401, Subchapter K of the tax code. So is it a marketing thing? Yeah, it might be. But the reality is all the things about it growing tax-free and pulling it out tax-free, that has to fit you, not the label. The idea and the vehicle has to fit you. So,
and there's Vern, there's a couple questions coming in from Barbara, and Barbara, I appreciate you being here. She says, which account is better for creating an IRA or 401? And you might going to cover this here in a minute, but which account is better for creating an IRA, 401k, a bank or brokerage firm?
Barbara, I'd have to say, and I'm going to answer a bunch of questions at the end too, but
sure.
That depends on you. I'm not a big fan of banks because about the most you're going to get. Typically, they will invest those in some longer-term CDs, and you're probably looking at 2 to 3, maybe 4% if you're lucky. And in a brokerage account, you could at least tie it to some sort of an index or work out some corporate bond strategy and have something that's going to generate 6 to 10%. So, or maybe a little more. It all depends, though, Barbara, if you can sleep at night, and that's really what matters, right? Not the return, whether or not you're comfortable with it. So I usually recommend brokerage just because there's more options. The other cool thing is you can do self-directed, so you can invest in real estate. I don't recommend putting real estate inside of that wrapper of a retirement plan, actual physical real estate. What I do recommend is if you're flipping or turning houses, that you can use an option strategy, which we could talk about, to create huge wealth inside of any of those vehicles, whether that's a regular IRA. You can have self-directed 401ks, self-directed Roths. There's some really cool stuff. The 7702 can be used for retirement like we talked about, but there's also some cool strategies I don't have time to go into today about how you can use it as your own bank. I've got real estate investors who have put a bunch of money into a 7702 and then they borrow it out for their real estate deals because they're still making money inside of their 7702. They're making a margin, right? Wealth is created in the margins, and they're making money on the real estate. When the real estate deal closes, they put it back in their 7702, pay that loan back, sometimes with a higher rate of interest because they're paying themselves. So again, I don't have time to talk about all that today, but there's super cool things you can do with that, and we could always talk about those, you know, one-on-one at some point too. So,
yeah.
Oh, and our Canadian friends at 7702. So what I did is I went and I looked, and the insurance taxation in Canada is very, very similar to the U.S. So you still have tax-deferred and tax-free vehicles with a life insurance wrapper, so to speak. And here's the thing. Life insurance, most people turn up their nose and say, I don't know about that. But most life insurance guys, what they do is they want to sell you a death benefit. That's not what this is about. the IRS has said, okay, in order to use this vehicle, we're going to dictate you have to have a certain amount of death benefit to get all these tax advantages. So what 7702, that tax code section really does is says what's the least amount of death benefit, because we're not doing this for death, that we can use to put as much money as fits your goals away. So the nice thing about that plan is, depending on your income, I mean, you could put as little as $5,000 away, or you could put $1 million away. There's just a lot of different ways to do it. So it all comes down to you, and you want to keep that insurance cost as low as possible. All right.
Some good questions coming in. There's some great questions coming in. We'll save it for the end just so he can get through this stuff.
Okay.
But I'm keeping note of them. Yeah, there's some really good stuff coming in.
And I'm going to go through everything else in fairly quickly, if I can get it open. There it is.
There we go.
Okay, so here's where we are. Now let's talk about some other core strategies of how do we save taxes today. Now, if you've been on this before, you might have seen some of this, but I'm going to talk about entities, because entities are typically the best way to save taxes with your business. And I'm going to talk about a C Corp strategy. And forgive me if I go through this fast. I want to make sure I answer everybody's questions, and we are on limited time. So what most people do first starting out in business is they set up a sole proprietorship. And they do that because it's easy, but you pay the highest taxes. Uncle Sam makes it easy for a reason. And you have no liability protection. And then somebody says, hey, I should have an LLC. And I'm going to explain this on my notepad again here in a second. An LLC can give you tax advantages. They're very flexible. It gives you liability protection, but you don't get any tax savings unless you elect to have that LLC taxed as either an S Corp or a C Corp, which we'll talk about here in a second. I'm going to draw some more pretty pictures for you. Then the next strategy is kind of an S Corp. They get tired of paying these taxes and they say, hey, I want to be an S Corporation. So this is what the next step that a lot of people do, and I'll put some numbers to it for you. You get to save some self-employment taxes, which is great, okay? And you do have liability protection. And the challenge is a lot of CPAs recommend this, and I do too. I usually recommend it as a stepping stone to get to the final step. But a lot of CPAs land here, and I hate to say it, but we're an industry typically, generally speaking, all real estate agents aren't the same and all CPAs aren't the same, but a lot of CPAs in the industry land here and they just stop and they don't take it to that next level. But a lot of the S Corp tax advantages were gone in 1986, and well, that's been a long time ago. So an S Corp, what that is it's a wrapper that gives you some tax advantages, but you still pay the tax on your personal tax return. All those items, the income, and the income flows through separately, and then a lot of the certain deductions like medical and health insurance and things like that, they flow through separately to you, so you can pay tax on those differently. And then there's a C Corporation strategy. The nice thing about a C Corp is it pays its own tax, okay? So if you really think about this, and it'll probably become clear when I draw it out, but if you have that entity paying tax at a lower tax bracket and you can shift money off of your personal tax return at a higher tax bracket, now we have a marginal difference. And now that marginal difference is something that you can create wealth with, okay? And then a C Corp has, a lot more and better deductions than an S Corp does in certain cases. Would I use it exclusively? Rarely. I'd like to use it with an S Corp, sometimes with a sole proprietorship, depending on your situation, to where you can use it, but you don't have to have all of your eggs in one basket, so to speak. And here's the separate tax brackets. So the first $50,000 of income is taxed at 15%. Well, if you're in the 33% tax bracket, and you can shift $50,000 over to the 15, you just saved 18%, and that's not counting state taxes, right? That's just federal. And then it gets, marginally less valuable. So that's why I say I like to use it in conjunction with something else. So the whole strategy here is how do we shift some of our income into a lower tax bracket? I'm going to switch.
That's a great question, Vern.
Yeah. Okay, so everybody got that? I know that now we take a second look at that, and it's kind of like clear as mud, right? But hopefully you follow it along. So let me draw some more. So now we're going to start out with our sole proprietorship, okay? And then we're going to talk about S Corp. And then we're going to talk about C Corp. Okay. Now all of these can be an LLC, okay? That's why I say I like LLCs, and they're very flexible. You can make an LLC taxed like any of these. LCC, how about that? I need more coffee, Scott.
There you go.
Okay, so I'm going to say, look, we've got $300,000 of bottom line income, okay? That's just kind of what we're going to use. I'm sure some of you are at that income level. Some of you are a lot higher. Some of you might be on your way there. It doesn't really matter. The thing about a sole proprietorship or an LLC taxed as sole proprietorship is you pay self-employment tax on all of your earnings. Now they cap the FICA portion, which is Social Security, at $119,000. But because of Obamacare, you pay Medicare, which is another 2.45% on all of your earnings. Okay, so if you made $300,000, we're going to have $19,700 just in SE taxes. Okay, that's before we even start talking about income tax. And I'm going to assume that there's some standard deductions and things like that. So our taxable income really comes down to like $278, and it's consistent through all of these, so that's just the number that we landed on. The tax on that is $65,700, and then you add the $19,700 to it, and so on $300,000 you're paying basically $85,400 in tax. Okay, basically a third, right? And that's a lot of tax.
Huge.
And that's not state tax included. So if you're in a 5% tax state, you take 5% of that $278. Or if you're in California, where I happen to live, we'd already be in the 13% tax bracket. So not too fun, right? $85,000 worth of tax. But what happens if we put that over here into an S Corp? So now we put $300,000 over here. And all the IRS says is that, okay, we know you're going to save some self-employment tax. You have to pay yourself a reasonable wage. And it's about the most ambiguous tax provision in the code, I think, because what is reasonable? I've had ranchers that made $300,000 that said, hey, $3,000 a year is reasonable, which I don't believe it is. And a lot of real estate agents that make that have paid themselves $50,000 a year, and it's been reasonable for decades. So that's the number I'm going to use. So we're going to pay $50,000 in wages. Now, why would we keep that wage so small? Because that's what we pay self-employment tax on, right? So now we're at $76.50 in self-employment taxes versus $19,700. Okay? And then we flow through rest of the taxes. We're still paying tax on the same amount. There's a few changes between the C and the S here, the Schedule C and the S Corp. So our income tax on this is actually $71,300 plus our $76.50. So we get up to basically, let's call it $79,000. Okay. Would you rather pay $79,000 or $85,000? Again, that's not super sexy, but the reality is that's $6,000. That's $500 a month. Scott, you actually mentioned that number earlier. That you can
Absolutely.
Save just by transitioning that. Okay. Now the C Corp, it pays its own tax. So I'm going to actually draw this out. Here's why I don't like to use the C Corp by itself. I like to use it in conjunction with an S. So here we're going to say this S Corp, you already have it up and running. We're going to take our C over here, and really what we wanted to do, right, is wanted to take that $300 that we were making, we want to shift some income. So let's just say we pay your own C corporation $100,000 to do your marketing maybe, or something like that, right? You can overpay marketing if you're paying yourself, right?
Yep.
So over here, we're going to say, okay, let's pay ourselves now $25,000 out of here and $25,000 out of here. So we're still paying the same 50. I want to keep that all even for comparison purposes. So now we've paid 100 over here from our 300. We've taken 25 out, and so what's going to flow down through to you is we're still going to pay tax at the individual level on $50,000 worth of wages and $250,000 worth of income. The bottom line is the tax now that flows through from here is $51,250. Okay? The tax over here that we're going to pay is on $75,000. And so that tax is going to be $7,500 on the first bracket, $62,50 on the next bracket. So we're going to pay $13,750. You add those two numbers together and you get about $65,000. So 65 compared to 85, or 65 compared to 79. You can see now the power of, okay, now we're starting to generate some true tax savings. And the nice thing about that is then with the C Corp and the S, depending on your personal situation, we get back to what we call those more and better deductions, and you get to start deducting even more. So, get a little sip of water here. Let's talk about some of those quickly, okay? Another income shifting strategy, I touched on this a lot usually, is pay your kids, right? If you can pay your kids and they can be in a lower tax bracket, they get $6,200 whether you claim them or not as a standard deduction. So if you pay them $6,200, you take that off your income tax return and you put it on theirs, and they're at zero tax. I like to pay kids, depending on their age. I've paid some pretty young kids, but typically when they get around that 10, 11, 12, on up through their teen years, when they're costing us a lot more money anyway,
right,
pay them at least 10, because at least now I'm using up some of their 10% tax bracket as well. Rather have them pay some tax at 10 than me at 30 plus my state, right? So that's a super powerful tool. I'm not going to go into a lot of detail on here.
So really, they're only paying tax on the 3,500 or something like that, or what is it?
Right,
6,200, 5,800.
Yeah, they get it's $6,200 is their standard deduction for this year. So you can pay them $62, and it doesn't cost them a dime in tax, but it saves you, 30-some% plus state because you pulled that off in the return. So there's a lot of cool strategies around paying your kids. Actually, I'll tell you a quick story. I have a real estate client in Texas, and she's in a high income level. Her husband's in a high income level, and everybody talks about these tax benefits you get for having kids in college, right? All the credits and stuff like that. Well, they were making too much money to do that, but they were still shelling out about $40,000 a year for their daughter. And so our strategy was, let's have the daughter just file her own separate tax return, not claim her. We'll pay her $40,000 in wages, and then she got all these tax credits. So not only did we get to take advantage for all the money we were paying out, she got to take advantage of all the credits because now she was in a lower tax bracket, and it worked really, really well. Saved
for both. Yeah,
ton of money. So let's talk about these more and better deductions. I took a lot of them out of here, but medical deductions in a C Corp, they're totally limited to 10% of your AGI on your personal return. 100% of medical deductions for employees can be deducted through your C Corp. That can be a huge tax savings. 127 is education. You can actually pay $5,000 a year per employee. So if your kids are an employee of your C Corp, you can use that to pay for their education, right? It doesn't get you very far these days, but it's better than not getting. Yeah. Section 125 cafeteria plans. These are really, really cool, and they're unused so much. You can use these with the Schedule C if you do it right. You can use them in an S Corp if you do it right. You can do it in a C Corp a lot easier than you can in the others. But just imagine if you were starting to pay all these expenses, medical, daycare, things like that. You can use a Section 125 plan. You're basically saving 40%. So what would normally cost you $10,000 out of pocket now costs you $6,000, right? Because of the tax savings.
Yep.
So, state taxes, we didn't talk about that. Your C Corp doesn't have to be in the same state as you. It pays its own tax. And so a lot of my clients will use a state like Wyoming or Florida or Nevada. Nevada's kind of expensive to run your corps through anymore just because they've gotten so popular with using it. Delaware's another one. They don't have state taxes, so if your income's flowing through there, that shelters it from your state tax. And you'll see a lot of Californians, especially since we have such high tax rates, starting to shift to an out-of-state corporation. They keep the S corp inside the state, they pay that other corporation outside of the state. Again, that has to work for you. So why isn't everybody do a C Corp? Well, a lot of people think they're complicated, and then there's this whole, wait a minute, a C Corp, it's the talk on the street, right, has double taxation. And that double taxation is, it's not really a myth, but what happens is if you pay a dividend out of a corporation, the corporation doesn't get the deduction, but the recipient has to pick it up as income. So that's double taxation. Well, that just happens to be like the worst way to take money out of your C Corp. So we just don't use that strategy very often. So double taxation with proper planning doesn't happen. So how do you implement this? Well, you choose a venue, your state, you file articles, you choose your fiscal year end if you want one, you create your bylaws, you get your ID number, and you're up and running. Okay? So I know I went through that fast.
Amen.
I'm going to really go through this one fast because I want to 10 minutes for questions. The DB plan strategy that I talked about in the LLC or in the tax later bucket, that's what this is all about, right? It's defined contribution is what most people do. This is defined benefit. So this is like, I'm not even going to go through those. Defined contribution is what most people are used to. Defined benefit is what it used to be, the old pension plan. And the defined benefit, the nice thing about that is you do two calculations. You say, this is what I want to make it my target retirement, and this is when I want to retire. And it might be sooner than 59 and a half, it might be later. But those calculations, and then an actuary, guy with the green eye shade, calculates some numbers based on those two factors in some IRS code. And that's how you get those deductions where you can put 150 or 500 or 600,000, whatever the number is for you, into a retirement plan and get those tax savings now. Some of you might be saying, well, gosh, you just showed us that tax never bucket. Why would I do that? And again, it has to be the vehicle that works for you. So this might work for some where it might not work for the person sitting right next to them. So anyway, defined benefit. There's a couple of things you need to watch out for. They do consider it a permanent plan, which means you need to keep it in place for 5 years at least. And you have to look at your other businesses, because if your wife has a different business or your husband has a different business and they have employees, you may need to cover them. So, wow. I feel like we went through that.
A lot of stuff, man. Here's the thing, man. Like you kind of alluded to a lot of different options, and not, like you said, the person sitting next to me might not have the same wants, goals, dreams, or desires that I do. There's different vehicles for every. Do you have anything that if someone wanted to talk with you or talk through, kind of like you and I are doing, do you have anything like that where someone, and I know you do, that you could provide for any member here that wanted to run through their scenarios and see if they would be a benefit to work with you or something like that?
Yeah, absolutely. And I'll walk through this fairly quickly too, because I truly want plenty of time for y'all's questions, because I know I went through stuff fast. So here's the basics right here, right? You need something that works for you. You need something that's flexible. You don't want to get locked into something that you're going to regret later on, and you want that freedom, right? So that's the bottom line. So here's what I always offer. I'll let you help me create your plan, okay? That's all I want to do, and here's how it's going to happen. Write this down. The website's save50kintax.com/strategy. So what's that mean? Okay, that's one of my websites, and when you go there, there's going to be an order form, which basically is show-up deposit. So how I work with people is I just want to help you create a plan. But obviously there's 1,000 people on this webinar. I'm not able to help everybody. So what I do is I just say, look, my time's valuable, your time's valuable. Leave a $500 deposit. It's totally refundable, no matter what, okay? You just ask for it back. It's yours. I don't want your money. I just want to make sure you keep your appointment and that we have a vested interest when we have a conversation that says, hey, I want some help. I'm not here to waste your time, Vern. I think you all appreciate that. In your industry, I know you have all the looky-loos that just want to go around, and I know you and look at houses. So anyway, that's why I have a show-up deposit. What happens after you leave that deposit is Carol, my assistant for 14 years, she's going to call you sometime in the next 48 hours to set up a time to talk. And you and I are going to get on the phone for anywhere between 15 minutes, 30 minutes, maybe an hour if that's what it takes. And we're just going to walk through several things. We're going to get on the phone, and I'm going to learn about your business. I need to know what works for you, what your income levels are, what you're doing, what your goals are, right? That's the most important thing is there's no tax strategy that fits everybody. There's no investment strategy that fits everybody. There's no house that fits everybody, right? So I need to know what you want to accomplish. We're going to talk about where you are now and where you want to get to. And then from that conversation, I'm going to start sharing these vehicles with you. And I said, well, you know, you need to maybe think about the tax never, or you need to think about the tax later and the tax never. You know, whatever these tools are, and obviously I've just showcased a few of them, we pull together that strategy that fits your business, that fits your goals.
Right on.
And then, at the end of that call, you're going to have a plan that's going to be tailored for you, that you can implement. Hopefully it'll save you thousands and thousands of dollars, if not $50,000 a year, and gives you that freedom you want.
Right on.
Here's where you say, okay, it's a refundable deposit. Why am I giving you money? One of three things are going to happen at the end of that call. You're either going to love the plan and decide to have your CPA implement with you. And I'm cool with that. And I'll talk to him if I need to. I'm going to say, good luck. Go get it done. Save some money. Have a good life. I appreciate being able to work with you. And I'm going to refund your $500. I didn't charge you for anything. I just want to make sure you showed up, right? So that happens. Number two doesn't happen very often. You know, we may just decide we're not a good fit. I've had some people who, you know, said they were at a different income level and we thought we could save them some more money, and it just didn't seem like it was a good fit. So sometimes that happens. Again, I refund your $500 and I wish you good luck. What happens most often is you say, hey, this is cool. Can you help me implement this and help me achieve my goals? And if that happens, then you become a client. And our clients, how we see ourselves is we're your financial quarterback. We help you implement the strategies in the plan. We change the plan when we need to and modify it, right? That's why we said we want it flexible. We take care of all your income tax forms. We consult monthly to keep you on track. And what that means is we're going to set you up with a scheduled time every month. And all you have to do during that scheduled time is pick up the phone and call and say, hey, let's talk about these things. And I'm going to keep you on track with that because I have my own agenda for those calls. That's not your only time to call me, though, right? You have email access to me. If you need something in the interim, you call. My clients always call. I just want to make sure. Often you talk to your CPA. My gut feel is once a year, maybe twice. I want to make sure we're talking monthly because I'd rather know stuff in advance, help keep you on track to achieve your goals, and know about it later. So we do all of this so you can basically focus on income. So if that sounds good to you and you want me to create a strategy for you, whether you even intend to have me help you implement it or not, I want to help you. Go there and we'll get started. Okay, we'll get some calls scheduled. We'll talk to you over the next week or so. We'll implement some strategies and decide if we're a good fit. So anyway, I know we're short on time, Scott. Let's hammer out.
Oh, man, it's good. It's good stuff. It's good stuff. So I appreciate you doing that for everybody. All right, so a couple questions. Is there an existing 501c3 in existence in Delaware, can a for-profit be established there as well as save on? However, having to register in your state to practice business there, how does that save on taxes? So
That might be
I
a
think
little
the
bit
question is,
outside of the scope of what we talked about, but a 501c3 is a nonprofit organization, and if you have a 501c3, you can also have a corporation. You obviously have to keep them totally separate. No commingling of funds or anything like that, or you'll be having reviews like the Clintons are going through now on their 501c3 challenge. So you can have a separate entity if that answers your question. If not, email me and I'll see if we can get a more specific answer for you.
all right, what is the minimum income for a C Corp when you are a real estate agent?
That's a great question. Most of my clients really don't get to that C Corp stage till they're probably, and this depends on what their spouse, if they're married, does too, because you've got to look at that global income. But I would say somewhere around 150,000 is the minimum. So if you're making 150,000 towards 175,000, you're probably going to get as much benefit out of your S Corp. And we can use some other strategies about shifting income rather than the C. The C Corp, what I love about it, obviously I told you, you have to be a little more sophisticated to use it though, right? So if you're at that 150 income level, it starts making sense. Now, if you're at 150 and you had $30,000 in medical expenses because of your personal situation, I'd have a totally different answer for you, right? So again, it comes down to what works for you personally. Or if you're putting a bunch of kids through school, does a C Corp strategy work better? It might. So, but I think below that 150 to 175, that's probably not something that you want to be looking at.
Okay. What about, here's a good one from Greer. It says, what about income that comes from some place other than the business, for instance, a salary income, as well as real estate income?
Okay, so the salary, again, that's going to work into your personal situation, but W-2 wages, an S Corp's not going to help you, sole proprietor's not going to help you, a C Corp's not going to help you, right? The challenge there is the way the tax code is when you're an employee, Uncle Sam takes his cut first, right? You make $10,000 in wages, Uncle Sam takes his cut, and they cut you a check for $7,000 or whatever the number is. So you pay your tax first and live on the difference. As a business owner making that same $10,000, sorry, I just got my better plug-in notice.
I see that, man. Let me just do something really quick. I don't know why I lose that.
Ooh. Okay, so as a business owner, you make $10,000, you live your life, and then you pay your taxes on the difference because of all the deductions we get. So I don't know if that answers your question, but the wages are definitely not a piece of what we're talking about with the entities.
Yeah, and someone, Debbie's got a great question, and this is probably not one we can answer on this one. It's a little long-winded, but what is the best way to plan for inheritance? I would, there's a link on the screen right now. It's save50kintax.com/strategy. That might be a great conversation to have with Vern. Again, the money is 100% refundable, but it might be that's probably a really good conversation to have.
Yeah, absolutely. There's some really neat things you can do when you're getting inheritance, and there's some tax consequences or not tax consequences depending on how and what you receive. And we do a lot of estate planning in my practice, and that's part of it. So let me know what I can do to help you.
But you have an issue with the okay. So Greer asked another good question. Do you issue them a 1099 if you pay your kids over 600? No, you can actually W-2 them. It's actually really easy to W-2 somebody. My accountant set it up for me, and she does all of that. So that's just a conversation you'd have with or have a conversation with Vern. He could set that up for you too.
Yep. And I've done it both ways. You can do it both ways. It just depends, again, on your situation.
James is saying, what was the total tax liability in your S Corp C Corp combo model? That was like
65,000.
65,000, yeah. Do you pay taxes on C Corp on state of nexus, income tax in state where your earnings are? So how can Florida, Delaware, Washington be a tax savings?
Oh, so
I think
it
you
depends
explained
on
that
where
one
your
already.
state of nexus is. So that's a conversation probably past the scope. But the nexus
Okay.
of an online marketing business is not necessarily in the state where you reside. So that's one of the ways we do it. If you have
Okay.
employees in that state other than the owner, then you might have some nexus issues, and then it would be prorated.
Here's a great one from Nicole. How would the S Corp setup work in Texas where there is no personal income tax? And I heard you were working with somebody in Texas. Would an S Corp be the best option for someone in Texas?
Yeah, as a matter of fact, some of my clients there had a Schedule C, and they were just paying a bunch of tax. And so our next legitimate step was to make them an S Corp. They didn't have state taxes, but it saved them all that self-employment tax, and then we were able to use that vehicle to shift some income over to some kids. So an S Corp makes sense as long as you wrote that right. A C Corp isn't going to save you state taxes in Texas, but it's going to save you that federal amount too. So a C Corp strategy will also work in Texas.
Excellent. All right. And then Troy's asking, does someone have to have enough cash in their Roth to pay cash for a flip real estate deal? Not sure what that is. That something you can do with the Roth? Can you borrow against it?
I'll quickly run through that, and this is just a highlight, okay? So, go to the website. I'll give you a strategy that'll make you a ton of money. But we use an option. So I go to the homeowner and say, I want to buy your house, but I'm going to give you an option on it because I know I'm going to flip it, right? Or you have a friend that buys the house and you option it, and you buy that option with, say, $1,000 out of your Roth IRA, and then when the profit gets turned to the eventual end user, you make money on that option. So you don't buy the house in the IRA, you buy the option on the house, and that's how you can do it with money.
So you're spending $1,000 just like, hey man, here's $1,000. It's 100% yours. I'm going to sell your house. That type of thing. So
It happened a lot when the real estate boom was going before we had the meltdown in 2006 or 7, whatever it was. A lot of people were assigning the contract. So you get the contract and you take an assignment fee. Well, your Roth IRA could do that too.
Okay. Here's Renee. Can you pay grandkids as well? Do we have to define what they are doing for us?
Yes and yes. You do need to kind of define. It can be loose, right? They can be doing office work. If you're paying a 10-year-old $50,000 a year, we're probably going to have a challenge. But if you're paying a 10-year-old $500 a month or maybe up to $1,000 a month, if you can say, hey, they're working, 15 hours a week.
Yeah.
We have to justify it. You have to have a justifiable position.
Can you pay your kids and their education if you're an LLC? I don't think there's any. That's just a limited liability company, right?
Right. It depends on, the LLC, like I said, is a really cool wrapper, but you have to elect on how you want it taxed, whether that's going to be Schedule C, which would be called a disregarded entity, or as an S Corp, or as a C Corp.
Got it. I think a lot of questions coming in about, you can work in other states. You're in California, but you work with people in like several states, right?
Oh, I have clients all over the country.
Clients all over the country. Okay, cool. All right, cool. Hey, Vern, that's about it. I think I answered most of the questions. Guys, if you have any more questions or would like to schedule a time with Vern, go to Save50K. That's on the screen, intax.com/strategy. I know he's helped several of our clients that have been on this call before in the past, and just some awesome stuff. So I think it's a great time to do it. Always a great time to think about saving money, and it's never too late to get started. I know that you have to put a plan in place, short-term, long-term. Short-term couple years down the road and long term. So there's just so many things that Vern's brilliant at, and when it comes to strategy. But he's got to get to know you, got to find out your short-term goals, long-term goals, how much money you have coming in, if it's going to be more or less, whatever. It's just a great conversation to have. So save50kintax.com/strategy. I appreciate what you do for our group, man. I appreciate all this information, and it's just an awesome job that you do with the people you do work with. So congratulations on that, man.
Thank you so much, Scott. It's always a pleasure to come. I just love sharing ideas, and hopefully you can take some of this stuff and implement it and save some money.
Absolutely. Absolutely, man. Absolutely. Okay, brother. Thanks so much, man. This recording will be up on the replay site. Get a hold of your loan professional for the copy of the recording and the PowerPoint. Vern, if you could ship that over to me, that'd be awesome. A copy of the PowerPoint so we can get that over. And then we'll see you guys same time, same place next week on Agent Mastermind. I appreciate you. And if you're joining us for the first time, make sure to go to our Facebook page, facebook.com/groups/Agent Mastermind. Everybody be safe. Enjoy St. Patrick's Day, and we'll see you on the web. Take care, everybody. Bye-bye.